Stop what you're doing, because if you blinked yesterday, you missed one of those market moments that changes people's portfolios, their confidence, and their entire mood in a single afternoon. And I'm not exaggerating. This wasn't a normal pullback. This was a trapdoor. My name is John A.G., and right now, as I'm recording this, New York Times says Saturday, January 31st at 11:58 p.m. Comment what time you're watching this, because I want to see how fast this story is traveling across the world. And quick heads up, we've officially launched our membership. So if you want shorter, faster analysis without the extra fluff, go check it out. The join link is in the description. Now listen, for months, people were strutting around like the metals market was a one-way elevator. Gold up, silver up, everything shiny up, and anyone who dared to say, "Watch your risk," got laughed at. Then Friday hit, and it didn't just humble the market, it humiliated it. In one session, the crowd got flipped from unstoppable to, "What just happened to my account?" Gold took a nasty hit. Silver looked like it got thrown off a cliff. Platinum and palladium didn't escape either. And if you were holding anything leveraged, you felt the kind of pain that makes people swear off trading forever. But here's the part most people still don't understand. The crash itself is not the scariest thing. The scariest thing is what it revealed about how fragile this trade had become, and what that tells us about what could happen next. Because the question isn't only, why did it drop? The question is, was this the end of the move, or was it an engineered shakeout before the next leg? And you're going to see why that question matters more than the price you saw on your screen. Before we go deep, check the description. I put bonus links there, including a premium WhatsApp channel link and a channel membership join link. If you want the updates the moment I see something shifting, that's where you'll find it. No fluff, just the signal. All right, let's rewind the tape. For about a year, metals ran like they were late for a flight. Gold didn't just climb, it sprinted. Silver didn't just sprint, it went borderline vertical. And when markets go vertical, two things always show up. New buyers who think it's safe, and old hands who quietly start setting exit plans. Then came Friday, a day that felt like a heavyweight punch you didn't see coming. Gold dropped close to 10% on the day in many places, and in the paper markets, the moves looked even uglier. Silver's drop was the kind of number you repeat out loud because you think you read it wrong. And the other precious metals followed, like they were all tied to the same anchor. Let me put some real texture on that, because numbers change how your brain feels the event. In many quotes running into the close, gold was trading under 5,000 again after flirting with the mid-5,000s just days earlier. Silver had been acting like it wanted to live above 100, and then, in a single hit, it was suddenly miles away from that line in the sand. Platinum and palladium, the metals most people ignore until they explode, got dragged down too, which is one reason I'm calling this a risk event, not just a metal event. And here's the weird part. The paper market didn't just drop, it distorted. In some screens, the near-month contracts were moving differently than the cash quotes, and that spread is a tell. When the front end disconnects, it's a sign that people aren't calmly trading value. They're scrambling for liquidity and collateral. That's what forced liquidations look like when you zoom in. Now, I'm going to say a sentence that'll make the comment section spicy. If you think the move was pure fundamentals, you're probably wrong. Fundamentals don't change in a single afternoon. Positioning does, liquidity does, and reflexive selling can turn a small shove into a free fall. So what exactly could have been sitting underneath this, like a tripwire? First, the gain itself. When an asset runs that hard, a lot of profit sits in the hands of people who aren't loyal. They don't believe, they rent exposure. And rented exposure disappears the moment the chart turns ugly. Second, the options gravity. Every big market develops magnet levels, prices where dealers are hedged, where gamma flips, where the hedging flow changes direction. You can't always see it, but you can feel it when the tape starts accelerating through certain numbers like they're not even there. Third, the collateral squeeze. In the days around big volatility, some clearing venues tighten requirements. They don't do it to punish you, they do it because volatility makes default risk rise. But from your perspective as a trader, it's brutal, because it forces selling at the worst moment. And when metals are the thing that's moving, metals are the thing that gets sold. Fourth, the dollar reaction. The dollar index, for context, jumped and was hovering around 97. That sounds boring until you realize how many automated strategies treat stronger dollar as a reason to reduce commodity exposure instantly. So even if the dollar move wasn't huge, the flows connected to it can be. And fifth, the narrative whip. Investors went from rates are coming down soon to maybe not in about the time it takes to microwave popcorn. That shift doesn't have to be correct to move markets. It only has to be believed long enough for the weak hands to dump. Now, here's the cliffhanger. The biggest clue about what happens next is not in the price. It's in how fast the market repairs itself after the forced selling ends. Because if the underlying bid is real, you'll see it show up in places that panic sellers can't hide from. We've seen this movie before, not with the same numbers, but with the same behavior. In 2008, gold sold off with everything else for a moment, not because the thesis died, but because people needed cash. Then, once the liquidity shock passed, gold went on a multi-year run. In early 2020, the same thing happened. A sharp hit during the scramble, then a powerful recovery as policy responded. Silver's history is even more dramatic. It's had moments where it looks unstoppable, then it collapses. Then it rebounds so hard people swear it's manipulation, when really it's just a thin market with big emotions. And yes, recently, silver had printed levels in January around $121 on some benchmarks. That's a fresh peak that matters because it tells you how stretched the rubber band was. The more stretched it is, the nastier the snapback, in either direction. So no, you don't get to assume it's over, and you also don't get to assume it's definitely going right back up. The market is going to make you earn the answer. One more thing. After a crash, spreads widen, liquidity thins, and the tape gets jumpy. The next week can be a trap full of fake moves. Trade smaller, breathe, and wait for confirmation before acting. Okay, now that you've got the mechanics, let's go back to the bigger question. What does history do after days like this? Now here's something important. When you see chaos like that, the price you're looking at is not a calm, accurate discovery mechanism. It's a snapshot taken during a stampede. And stampede prices can be misleading because the real battle happens after the first wave of forced selling is done. So yes, I'm going to talk about what happened. But more importantly, I'm going to talk about the mechanics that turned a bad day into a meltdown, and then we're going to step back and ask the bigger question. What does history do after days like this? And when I say history, I mean the cold, boring, unemotional kind. The kind that doesn't care about your feelings. Now, what set this off? The headline catalyst people latched onto was the announcement of a new pick for the top job at the central bank. The market heard sound money and instantly did what markets do. It repriced expectations. A stronger dollar reaction, a rate path reaction, a tighten the screws reaction. And in a trade that had become crowded, that was enough to pull the first brick out of the wall. But I want to challenge the simplistic version of that story, because if you're telling me that one personnel headline alone explains why silver can get body slammed in a single day, I'm going to push back. That explanation is too neat. Markets are rarely that clean. What's more likely is this. The headline was the match, but the room was already full of gasoline. Based on recent market updates, there were multiple stress points building at once. Extreme positioning, stretched sentiment, big options levels that traders watch like hawks, and margin dynamics that can change the rules mid-game. And when all of those align, you don't need a huge spark. You just need a spark. Here's how the cascade typically works, and you need to understand this because it's the same movie every time, just with different actors. Step 1. Price slips. Not even a crash yet, just a slip. Step 2. That slip hits the level where a ton of traders placed automatic exits. Stop orders. Liquidation triggers, risk controls, the boring stuff nobody brags about on social media. Step 3. Once those triggers hit, sell orders fire into the market without emotion. They don't care if the price is cheap. They don't care about the long-term story. Their job is to exit now. Step 4. That wave pushes price lower, which hits the next cluster of triggers, which fires more selling, which pushes price lower again. That's the domino line. And once it starts, it doesn't stop because people are rational. It stops when the market runs out of forced sellers, or when a big buyer decides the price is now ridiculous. And that's where the sharks show up. Because there are players who can see the structure. They can sense where the weak hands are. They know roughly where the clustered exits live. So when the first wave begins, they press. They short into the chaos, not because they think the metal is worthless, but because they know the plumbing of the market is about to get clogged with panic. And when the panic is finished, that's when they cover. Quietly, aggressively, sometimes brutally. Now, add leverage to this and it gets ugly fast. If you're trading futures, you're not putting up the full value of the position. You're posting a fraction. If price moves against you, you get a margin call. You don't get to argue. You don't get to negotiate. You pay up or you're out. If you're trading contracts that magnify your exposure, the platform itself may force you out earlier than you expect because it has to protect itself. That means your position can be closed at the worst possible moment, right when the market is in free fall. And if you were in a leverage product tied to silver, Friday was a lesson in why leverage is a chainsaw. Great when it's working, life-changing when it slips. So yes, a stronger dollar can pressure metals. Yes, rate expectations can matter. But the real engine of a day like Friday is mechanical selling amplified by leverage. That's the part people forget, and that's why they get blindsided. Now let's talk about what else moved, because it tells you whether this was metals specific or risk off everything. Stocks wobbled. Not a total collapse, but you could feel the mood shift. The broad indexes took hits, and the tech-heavy side felt heavier. Nothing apocalyptic, but enough to say people were de-risking, not just rotating. Crypto didn't play hero either. A lot of folks love calling it digital gold, right up until it behaves like a high beta risk asset. It slipped again, continuing a trend that had already been rolling over for a while. And then there was the sector that felt it the most: miners. If you own mining shares, you know this pain. When metals go down, miners often go down harder, because they're a leveraged bet on the underlying. Their costs don't instantly fall just because the metal price fell today. Their margins compress, investors panic, and the stocks get dumped. But here's the twist. Miners also tend to rebound harder when metals stabilize. Not always, but often. And that's why the next few sessions matter. Because the first move after a waterfall drop can tell you if this was a reset or the beginning of a longer unwind. Now, let's zoom out. I spent time digging into what markets tend to do after single-day shocks. Not because the past repeats perfectly, but because human behavior rhymes. Fear, greed, forced selling, overshooting, relief rallies. Same emotions, different decade. And the first thing you learn is that truly massive single-day drops are rare. Even in stock history, you don't get that kind of day often. When you do, it usually happens around a bigger narrative: credit stress, war news, policy surprises, systemic leverage. Big drops are usually about systems, not just stories. So what happens after a big down day? Here's the pattern that shows up more often than people expect. The first reaction is chaos, and then the market often snaps back hard. Not because everything is fine, but because the sell-off created an imbalance. Too many sellers, not enough liquidity, and then, suddenly, price becomes attractive to someone with cash and patience. That's the rebound, and it can be violent. But, and this is a massive but, not every crash is a gift. Sometimes crashes are the first crack in a longer break. The trick is figuring out which one you're in. So instead of guessing, we need to look at the structure and metals specifically. Gold and silver are not the same animal. Gold is the heavyweight. It moves, but it usually moves with restraint compared to silver. Big daily drops in gold are relatively uncommon because gold's market is deep and gold is held by institutions that don't flip their positions on a whim. Silver is the wild cousin. It's smaller, it's more volatile, and it's pulled around by both industrial demand and investor speculation. That makes it explosive on the way up and brutal on the way down. So a day that feels impossible in gold can be rare but not unheard of in silver. And that matters because when you're trying to estimate what comes next, you can't treat these like identical twins. They share DNA, but they don't share temperament. Now, based on recently published numbers, silver had just tagged levels in January that many people were calling historic. Gold, too, was sitting in territory that would have sounded insane not long ago. When you stack gains that quickly, you create a fragile tower. Everyone is up, everyone is confident, and everyone has tight risk controls. Until the first drop hits, and those controls become accelerants. That's why Friday felt like a rug pull. Now here's the key question for Monday and the week ahead. Do we see follow-through selling, or do we see stabilization? If we see a sharp rally early, that suggests forced sellers are done, and bargain hunters are stepping in. If we see dead cat bounces that get slapped down, that suggests bigger players are still unloading and using strength to sell. And if we see sideways chop, that's the market trying to find a new equilibrium. Let me explain something else people miss. After a crash, the quote you see doesn't always match reality on the ground. In physical markets, spreads widen. Dealers protect themselves. Buyers demand discounts. Sellers get offered less. The paper quote can say one thing while the real-world transaction is happening at a very different level. So if you're thinking about buying or selling right after a shock, you're stepping into a zone where the bid-ask spread is a battlefield. That's why patience is a weapon. Now let's talk about the dollar, because it's part of the narrative whether you like it or not. When the dollar strengthens, commodities priced in dollars often feel pressure. It's math. If you're outside the US, a stronger dollar makes it more expensive to buy the same ounce. That can cool demand at the margin. And according to public data updates that hit after Friday, the dollar index jumped about 1% on the day, sitting in the high 90s. Again, that's not the whole story, but it's part of the backdrop. But here's the thing. A one-day dollar move doesn't erase a year of monetary realities. It doesn't erase debt. It doesn't erase deficits. It doesn't erase the long-run incentives that push policymakers toward easier conditions when something breaks. So if you're thinking, aha, stronger dollar means metals are dead, slow down. That's a conclusion people love to shout right at the moment they're least likely to be right. Now, I'm going to say something that will irritate both extremes. If you're a die-hard bull, you need to accept that parabolic moves get corrected. That's not betrayal, that's biology. Markets breathe. They surge, they exhale, they surge again. And if you're a die-hard bear, you need to accept that crashes often create the next opportunity. Not always, but often. The market loves to punish the maximum number of people, and that includes people who panic sell at the bottom and then watch a rebound without them. So what does history suggest after a hard crash day in metals? When you study past instances of big daily drops, you see a pattern that leans bullish over longer horizons. Not because the world is always wonderful, but because extreme down days tend to create oversold conditions. And oversold conditions tend to mean the next move is more likely to be up than down. But the timing is the trap. The rebound can take days, weeks, sometimes months, and the first attempt can fail before it works. That's why Monday is not the end of the story. It's the start of the next chapter. Now I want to bring in something that wasn't in the competitor chatter going around this weekend: the role of margin and collateral rules. In commodities, exchanges and clearinghouses can raise margin requirements when volatility spikes. That means traders have to post more cash to keep positions open. And if they can't, they're forced to reduce. That reduction is selling pressure, regardless of belief. This is one reason big moves can accelerate right after they begin. The system itself demands more collateral, and the weakest hands don't have it. And from the latest publicly available updates, margin tightening has been part of the conversation in multiple venues after the Friday move. That matters because it suggests the selling pressure wasn't purely opinion. It was structural. Now, what about the ripple effect beyond metals? There's been chatter about whether a metals crash predicts a stock crash. Sometimes people try to make that link because they want a simple narrative. Gold down means people are confident, gold up means people are scared, and so on. Reality is messier. Sometimes stocks and metals fall together because it's a liquidity event. People sell what they can, not what they want. Sometimes metals rise while stocks fall because investors are seeking safety. Sometimes both rise because money is flooding into everything. So the correlation is unreliable. It's not a clean signal. Anyone selling you certainty there is selling you a story, not a model. What Friday did show, though, was a classic sell risk, raise cash vibe, and that can spill into anything crowded. Now, you might be thinking, so should I buy? Should I sell? Should I hide under my desk? Here's my approach. Don't let one day hypnotize you. If you were positioned responsibly, meaning you didn't bet the rent, you didn't use insane leverage, you understood volatility, then a day like Friday is painful, but it's survivable. If you were positioned irresponsibly, Friday is your wake-up call. Not because metals are evil, but because volatility doesn't care about your conviction. Now, let's talk about the longer-term case, because it didn't vanish overnight. We still live in a world where governments prefer growth over austerity. We still live in a world where geopolitical tension can flare without warning. We still live in a world where reserve diversification is a real conversation, and where the credibility of fiat policy is constantly being tested. Those are not Friday-only issues. Those are structural issues. And that's why, even after a crash, you'll see serious institutions stay interested in gold. They may rebalance. They may hedge. They may reduce risk when volatility spikes. But the thesis doesn't evaporate because a chart went red for a day. Silver's thesis is different because silver has an industrial backbone. It's used, consumed, and demanded in ways gold isn't. That demand doesn't move in a straight line, but it's real. And it's one reason silver can come back hard after it gets washed out. Now, I'm going to tease something that I think a lot of people will miss. The emotional takeaway from Friday is the bubble popped. But the structural takeaway might be the froth got cleared. Those are not the same. A true top is usually a process, not a day. It often involves distribution, failed rallies, multiple peaks, and a gradual shift where buyers stop showing up. A single-day crash can be part of that. Or it can be the classic liquidation event that resets leverage and allows the trend to continue later. So how do we tell? We watch behavior after the shock. We watch whether buyers defend key levels. We watch whether volatility compresses. We watch whether the narrative changes from panic to opportunity. And we watch the dollar and rates. Because if the market decides the new central bank leadership means tighter policy, that can pressure metals longer. But if the market decides the new leadership will ultimately be aligned with political pressure for easier conditions, that can flip the story. This is why the weekend headlines matter less than the Monday reaction. Markets don't trade the news, they trade the change in expectations. Now, another new piece of context. Globally, precious metals don't trade in isolation. Different regions react to different triggers. In parts of Asia, weekend trading and local policy announcements have been adding extra volatility to metal-linked assets. Some commodity-related equities even hit exchange limits in special sessions. That kind of cross-market stress can feed back into sentiment. So if you're only watching one screen, you're missing the echo. Now I want to address a mistake people make right after a crash. They assume the first bounce is the all clear. Sometimes it is. Sometimes it's a trap. A lot of rebounds after violent drops are short covering. That means people who were short are buying back to lock profit. That buying can lift price fast. But once they're done, if real demand isn't there, price can sag again. So if you see a rally, don't automatically marry it. Watch if it holds. Watch if volume supports it. Watch if dips get bought. Here's a question for you. Do you think Friday was a genuine top? Or do you think it was a shakeout designed to eject late buyers before the next run? Drop your take in the comments. I read more than you think. Now, let's talk about the crowded trade concept, because it explains why the fall felt so violent. When everyone is on the same side, the market becomes vulnerable to surprise. It doesn't take much to spook the crowd, because the crowd is already heavily committed. You could see it in sentiment. You could see it in how casually people talked about price targets. You could see it in how many new accounts were suddenly experts in metals. That's usually a late cycle signal. But again, late cycle doesn't always mean final cycle. It means risk is elevated. Now, here's where I bring in the part that's going to surprise some people: the math of rebound odds. In broader market history, after a large one-day drop, the probability of a positive return over the next year has often been better than people think. Not guaranteed, but tilted. In metals history, especially in silver, big down days have often been followed by strong recoveries over longer windows. Silver is built for drama. It doesn't do gentle. It does rip your face off, in both directions. That's why your time frame matters. If you're a day trader, Friday was a nightmare. If you're a long-term holder with patience and sane sizing, Friday might eventually be a story you tell as, "That day I got a chance." And yes, I know that sounds easy to say after the fact, but it's also the most practical truth. The market punishes impatience. Now, I'm not going to pretend I can tell you exactly what Monday prints. Nobody can. Anyone who claims they can is either lying or selling something. What I can do is lay out the scenarios. Scenario 1, relief rally. Price gaps up, volatility cools, and the market spends the week rebuilding confidence. That would suggest the crash was mostly liquidation. Scenario 2, continuation. Price bounces, fails, and sells off again. That would suggest bigger distribution and a deeper reset. Scenario 3, whipsaw. Big swings, fake-outs, violent intraday reversals. That would suggest the market is still fighting over positioning, and it's not ready to pick a direction. And here's the punchline. All three can happen in sequence. That's why you don't bet your life on the first hour of Monday. Now, because I know a lot of you actually care about building wealth and not just watching charts, I'm going to say this. If you're successful, share your success story in the comments so others can stay motivated. People need to hear that consistency wins, especially after a day like Friday. Now, I also want to talk about something we offer here because it ties into how you manage uncertainty. We have members-only videos produced by a separate team that goes deeper, with more research and more data work, and those are only for premium members. That's where we map out scenarios, highlight risk levels, and talk through setups in a calmer way. If you want that, the join link is in the description. Back to the market. One of the most dangerous moments is right after a crash, when spreads are wide and emotions are raw. If you rush into a coin shop or a dealer desk immediately, you may get punished by the spread alone. If you rush into selling, you may lock in the worst print of the week. So if you're going to act small. Test, don't leap. Also, if you're holding metals-related funds, remember they can deviate from underlying value during chaos. Discounts and premiums can appear. Liquidity can thin. That's not conspiracy. That's how markets behave when everyone hits the door at once. Now, let's circle back to the central bank story, because it's the headline everyone is stuck on. The market initially interpreted the pick as hawkish. That's why the dollar jumped and risk assets felt pressure. But personalities are complicated. Public statements evolve. Incentives matter. Political pressure matters. So the real question is not, what did he do years ago? The real question is, what will the committee do when the economy slows, when markets wobble, and when the pressure builds. Because history suggests the bias is toward easing, not tightening, when pain shows up. And if that bias reasserts itself, metals can find a floor quicker than people expect. Now, I want to pull the camera back even further and talk about cycles. Metals tend to move in waves. Big wave up, correction, consolidation, next wave. The correction is often sharp and scary. The consolidation is often boring and frustrating. Then the next wave surprises people who gave up. That's why most people don't capture the full move. They buy late, panic early, and then watch from the sidelines. Friday was a stress test, not just for price, but for psychology. So here's my bottom line. If you believe in the longer-term case for hard assets, one bad day doesn't delete the thesis. But you must respect volatility. That means sizing positions so you can survive the swings. It means avoiding leverage that can liquidate you at the worst moment. It means planning before the chaos, not during it. If you're purely trading, then your job is different. Your job is to protect capital first. You can always re-enter. You can't always recover from a forced liquidation. And for everyone, the next week matters. The market's reaction will tell you whether Friday was a one-day purge or the first crack of a larger unwind. So here's my second question for you. What would make you change your mind? What price action would convince you this was just a reset? And what would convince you it's a long-term top? Put it in the comments. I want to see how you think. One last thing. Keep an eye on how the dollar behaves and how rate expectations shift over the next few sessions. Those two levers can change the mood fast. And watch for any further rule changes around margin and collateral, because those can force flows regardless of anyone's opinion. If you found this breakdown useful, subscribe so you don't miss the follow-up. And remember, the description has those bonus links, including the premium WhatsApp channel and the membership join link, so you can plug into the updates and the deeper members-only research. All right, take care of yourselves, don't let a single red day hijack your entire plan, and I'll see you in the next one. And just so we're crystal clear, nothing in this video is financial advice. I'm sharing my interpretation for education and discussion, and you should always make your own decisions based on your situation, your risk tolerance, and professional guidance if you need it.